On March 16, 2008, inside the headquarters of J.P. Morgan Chase in New York City, government officials and bank executives finalized the emergency sale of Bear Stearns for $2 per share, a price later revised to $10 under shareholder pressure. The investment bank, which had survived the Great Depression and multiple financial crises, collapsed in days after a liquidity crisis triggered by its massive exposure to subprime mortgage-backed securities. 6 months later, another institution would not be so fortunate. Lehman Brothers, founded in 1850 by German immigrant Henry Lehman in Montgomery, Alabama, had evolved from a cotton trading operation into the fourth largest investment bank in the United States by 2008, with assets totaling over $600 billion. The firm had survived the Civil War, 2 world wars, the Great Depression, and the collapse of long-term capital management in 1998, but it would not survive the subprime mortgage crisis that began to unravel in 2007. Under the leadership of Chief Executive Officer Richard Fuld, who had run the firm since 1994, Lehman Brothers had aggressively expanded its mortgage origination and securitization business throughout the early 2000s, acquiring subprime lenders including BNC Mortgage and Aurora Loan Services. By 2007, Lehman held approximately $50 billion in commercial real estate holdings and residential mortgage-backed securities, positions funded largely through short-term borrowing in the repurchase agreement market. The financial engineering underpinning these positions relied on continuous access to overnight funding, a vulnerability that would prove fatal when confidence evaporated. The warning signs emerged throughout 2007 as home prices began declining and delinquencies on subprime mortgages accelerated across the United States. In August 2007, credit markets seized as investors lost confidence in structured products backed by mortgages, and the asset-backed commercial paper market contracted sharply. Lehman Brothers reported record revenues of $19.3 billion for fiscal year 2007, but the firm's exposure to deteriorating real estate assets was becoming increasingly difficult to conceal. The company employed accounting maneuvers including Repo 105 transactions, a practice that temporarily removed assets from the balance sheet at quarter end to reduce reported leverage ratios, making the firm appear less risky to investors and regulators. These transactions, which involved selling securities with an agreement to repurchase them after the reporting period, were approved by Lehman's external auditor, Ernst & Young, but would later become central to investigations into the firm's accounting practices. Throughout the first half of 2008, Lehman's stock price deteriorated as investors questioned the valuations of its real estate portfolio and its ability to raise capital. In March 2008, immediately following the Bear Stearns collapse, Lehman's share price dropped 29% in 2 days on concerns it would be the next domino to fall. The firm reported a loss of $2.8 billion for the second quarter of 2008, its first quarterly loss since going public in 1994, and announced plans to raise capital by selling assets and issuing new stock. Lehman raised $6 billion through a stock offering in June 2008, but this capital infusion proved insufficient as the firm's asset values continued to decline and counterparties grew increasingly reluctant to engage in transactions with the investment bank. The Federal Reserve, under Chairman Ben Bernanke, and the Treasury Department, led by Secretary Henry Paulson, monitored Lehman's deteriorating condition throughout the summer of 2008, while simultaneously managing other financial emergencies, including the conservatorship of mortgage giants Fannie Mae and Freddie Mac in early September. The regulatory architecture that governed investment banks in 2008 was fundamentally different from that of commercial banks, as investment banks were primarily regulated by the Securities and Exchange Commission under a voluntary consolidated supervised entity program that lacked the authority and tools available to bank regulators. This regulatory gap meant that the Federal Reserve did not have established emergency lending relationships with investment banks and faced legal and practical constraints in extending support. By September 2008, potential acquirers had examined Lehman's books, including Bank of America and the British bank Barclays, but concerns about the scale of losses hidden within the real estate portfolio and the lack of government guarantees similar to those provided in the Bear Stearns transaction made the deal elusive. On Friday, September 12, 2008, Lehman Brothers stock price closed at $3.65 per share, down from a peak of $86 just 18 months earlier, and senior executives gathered at the Federal Reserve Bank of New York for emergency weekend meetings that would determine the firm's fate. On September 13, 2008, inside the fortress-like building of the Federal Reserve Bank of New York at 33 Liberty Street in Lower Manhattan, Treasury Secretary Henry Paulson convened an emergency meeting of Wall Street's most powerful executives, including J.P. Morgan Chase CEO Jamie Dimon, Goldman Sachs CEO Lloyd Blankfein, and Morgan Stanley CEO John Mack, to devise a private sector solution to the Lehman Brothers crisis. Paulson, a former Goldman Sachs chief executive himself, made clear that unlike the Bear Stearns rescue 6 months earlier, no government money would be available to facilitate a Lehman acquisition, a position driven by political concerns about moral hazard and the precedent of repeated Wall Street bailouts. Throughout that weekend, 2 potential buyers emerged with serious interest in acquiring Lehman's assets: Bank of America, led by CEO Kenneth Lewis, and Barclays, the British banking giant represented in negotiations by its president, Robert Diamond. Bank of America withdrew from discussions on Sunday morning, September 14th, choosing instead to pursue the acquisition of Merrill Lynch, another troubled investment bank whose condition had deteriorated rapidly in recent weeks. This left Barclays as the sole remaining bidder, but British financial regulators at the Financial Services Authority refused to approve a transaction without a comprehensive guarantee of Lehman's liabilities, something American authorities would not provide, and British law made difficult to implement without shareholder approval, a process requiring weeks. As Sunday evening approached with no deal in sight, Lehman Brothers Holdings Inc. prepared to file for bankruptcy protection, a decision that would trigger the largest bankruptcy filing in American history, with $613 billion in assets and $619 billion in debt. At 1:45 a.m. on Monday, September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection in the United States Bankruptcy Court for the Southern District of New York. Markets opened hours later to chaos as the Dow Jones Industrial Average plummeted more than 500 points, the largest single-day decline since the September 11, 2001 terrorist attacks, though this record would be broken multiple times in the weeks ahead. The immediate contagion spread through multiple channels as Lehman's bankruptcy froze $300 billion in assets, leaving creditors uncertain about recovery prospects and counterparties exposed to unwind trades across derivatives, repurchase agreements, and prime brokerage relationships. Money market funds, which had invested in Lehman Brothers commercial paper, assuming investment-grade safety, suffered immediate losses, most notably the Reserve Primary Fund, which held $785 million in Lehman debt and announced it had broken the buck, with its net asset value falling below $1 per share. This triggered the first run on money market funds since the 1930s, as investors withdrew hundreds of billions of dollars within days, forcing the Treasury Department to announce an emergency guarantee program for money market mutual funds on September 19, 2008. The credit markets, already under stress throughout 2008, essentially froze as the London Interbank Offered Rate, the benchmark rate at which banks lend to each other, spiked to levels indicating complete distrust among financial institutions. American International Group, the global insurance conglomerate that had sold credit default swaps on mortgage-backed securities without adequate reserves, faced its own liquidity crisis in the immediate aftermath of Lehman's failure and required an $85 billion emergency loan from the Federal Reserve on September 16, 2008, to avoid bankruptcy. A loan that would eventually expand to over $180 billion as the government took an ownership stake approaching 80%. The financial crisis accelerated dramatically in the 2 weeks following Lehman's collapse, forcing emergency interventions across the global financial system. Goldman Sachs and Morgan Stanley, the two remaining independent investment banks, converted to bank holding companies on September 21, 2008, bringing them under Federal Reserve supervision and providing access to emergency lending facilities, effectively marking the end of the standalone investment banking model that had defined Wall Street for decades. The Emergency Economic Stabilization Act, initially rejected by the House of Representatives on September 29 in a vote that sent the Dow Jones down 778 points, was revised and passed on October 3, 2008, creating the Troubled Asset Relief Program with authorization to purchase up to $700 billion in distressed assets from financial institutions. Central banks worldwide coordinated unprecedented interventions, including coordinated interest rate cuts and the expansion of currency swap lines to address dollar shortages in international markets. The real economy consequences extended far beyond Wall Street as credit contracted sharply. Unemployment rose from 5% in January 2008 to 10% by October 2009, and global trade volumes collapsed at rates not seen since the 1930s. The Examiner's report, produced by Bankruptcy Court-appointed examiner Anton Valukas and released in March 2010, documented the Repo 105 accounting manipulations and identified potential claims against Lehman executives and Ernst & Young, though criminal charges were never filed against senior executives. Richard Fuld testified before Congress in October 2008, stating that he took home approximately $300 million in compensation during his tenure as chief executive, a figure disputed by others, but symbolic of the wealth extracted before the collapse. The Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law in July 2010, implemented sweeping regulatory changes, including enhanced capital requirements, the Volcker Rule restricting proprietary trading, the creation of the Financial Stability Oversight Council to monitor systemic risks, and the establishment of Resolution Authority allowing regulators to wind down failing financial institutions without triggering the chaos that followed Lehman's failure. More than 15 years after the collapse, questions persist about whether Lehman Brothers could have been saved through government intervention, whether its failure was necessary to prevent further moral hazard, and whether the regulatory reforms implemented since 2008 adequately address the structural vulnerabilities that produced the crisis, as global debt levels have grown substantially and new forms of shadow banking operate beyond traditional regulatory perimeters.